Stock prices change every day because of supply and demand. When more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. This fluctuation is influenced by various factors including company performance, economic conditions, and market sentiment. Understanding these changes can help investors make better decisions. For example, strong company earnings reports can boost investor confidence, leading to higher stock prices. Conversely, economic uncertainty or poor company performance can cause prices to fall. By studying market trends and economic indicators, investors can develop strategies to manage risks and capitalize on opportunities in the stock market.
Investing is key to business success. It involves putting money into assets to make more money in the future. There are different strategies like growth, value, and index investing. Growth investing focuses on companies that are expected to grow faster than others. Value investing looks for companies that are undervalued but have potential. Index investing involves buying stocks that represent a market index to mirror its performance. Each strategy has its own risks and benefits. Understanding these can help you choose the best one for your goals. Learning about these strategies is important for making informed investment decisions and achieving business success.
Understanding corporate economics and performance analysis is key to mastering the market. This involves studying how companies make money, spend it, and manage their resources. By analyzing financial statements, we can see a company's health and predict its future. It's also important to understand market trends and how they affect businesses. This knowledge helps companies make smart decisions, like when to launch new products or enter new markets. Learning about different economic theories also provides insights into why markets behave the way they do. By mastering these concepts, businesses can thrive even in challenging economic times. This is essential for anyone looking to succeed in the business world.
Understanding the process of an initial public offering, IPO, is crucial for any business looking to enter the public market. An IPO is when a company sells its shares to the public for the first time. This move can provide a company with capital for growth, but it also requires careful planning and understanding of the market. Key steps include evaluating the company's value, choosing the right time to go public, and complying with legal requirements. It's also important to communicate effectively with potential investors about the company's prospects. Success in an IPO can lead to increased visibility and credibility, but the risks include losing control and facing market pressures. Learning about IPOs is essential for anyone involved in business.
In the world of global business, understanding exchange rates is crucial. Exchange rates tell us how much one currency is worth in terms of another. There are two main types, fixed and floating. Fixed rates are set by governments and do not change often. Floating rates, however, can change frequently. They are determined by the market, based on supply and demand. For businesses, knowing these rates helps in planning international payments and investments. A stable exchange rate can make business easier, while a volatile rate can increase risks. By mastering these concepts, businesses can better navigate the complexities of international trade and finance.
Understanding how markets work is crucial for managing a business's investments effectively. This involves learning about different types of financial assets like stocks, bonds, and real estate. Portfolio management is the process of selecting and overseeing these assets to achieve the best possible returns while managing risk. It requires knowledge of economic trends, company performance, and global events. By balancing various investments, businesses can protect themselves from unexpected market changes. This strategy helps in achieving long-term financial goals. Effective portfolio management is not just about choosing the right assets, but also about timing, knowing when to buy or sell. This skill can significantly impact a company's financial health and success.
Understanding interest rates and quantitative easing is crucial for mastering the financial markets. Interest rates, set by central banks, influence the cost of borrowing money. When rates are low, borrowing is cheaper, encouraging spending and investment. Conversely, high rates can slow down the economy by making borrowing more expensive. Quantitative easing is another tool used by central banks. It involves buying financial assets to increase money supply and lower interest rates, stimulating economic growth. However, these policies can also lead to challenges like inflation. By learning how these mechanisms work, business professionals can make better financial decisions and anticipate market trends, which is essential in today's dynamic economic environment.
When starting a business, finding money to begin is crucial. Seed capital is the initial funding used to start developing a product or service. It often comes from the entrepreneur's savings or from friends and family. As the business grows, more money might be needed. This is where venture capital comes in. Venture capitalists are investors who give larger amounts of money in exchange for a part of the company. Another popular method is crowdfunding, where many people give small amounts of money, usually through the internet. This can be a great way to raise funds without giving up ownership. Understanding these options helps entrepreneurs choose the best path for their business growth.
Dividends are payments made by a company to its shareholders from its profits. Understanding how dividends work is crucial for anyone looking to invest in businesses. When a company earns money, it can either reinvest it into the business or distribute some of it to shareholders as dividends. This decision impacts the company's growth and the value of its shares. Investors often view regular dividends as a sign of a company's financial health and stability. By mastering investment strategies that focus on dividend dynamics, businesses and investors can make informed decisions that promote long-term growth and profitability. This knowledge is essential for anyone pursuing a career in business or looking to enhance their investment portfolio.
Real GDP, or gross domestic product, measures the total value of goods and services a country produces. It's important because it shows the size of an economy. When real GDP grows, it means the economy is getting stronger. Growth rates tell us how fast the economy is expanding or contracting. A positive growth rate means the economy is growing, which is usually good news. Economic cycles are periods of growth and decline in the economy. These cycles include booms, when the economy is doing really well, and recessions, when it is doing poorly. Understanding these concepts helps businesses make better decisions, like when to invest or cut costs.
Stock market indices are like thermometers for the economy. They measure the health of the market by tracking the performance of selected stocks. For example, the Dow Jones Industrial Average looks at 30 large companies in the U.S. If the index goes up, it suggests businesses are doing well. If it goes down, there might be economic troubles. Understanding these indices helps investors make informed decisions. They show trends over time, helping predict future market movements. By studying these indices, business people and investors can better understand economic cycles and make smarter investment choices. This knowledge is crucial for anyone involved in the business world.
In business, understanding economic forces like inflation, deflation, and stagflation is crucial. Inflation means prices of goods and services rise. This can reduce the value of money as you need more to buy the same things. Deflation is the opposite, prices drop. This might sound good, but it can lead to reduced business profits. Stagflation is when the economy doesn't grow, but prices still rise. This is challenging because it combines the problems of inflation and a weak economy. To navigate these conditions, businesses must plan carefully, adjust pricing strategies, and manage costs effectively. By understanding these concepts, businesses can make better decisions and remain strong in changing economic environments.